Dear investors, welcome to Phillip Securities Research Weekly Market Watch. My name is Kok Ju, the Head of Research. Last week, we wrote that Singapore may avoid a technical recession as industrial output rebounded strongly in December, easing sharply the pace of contraction and setting up first quarter 2012 for an on-quarter expansion. However, the rebound could be weak as external conditions could still be challenging. Friday's fourth quarter 2011 US GDP report was below expectations, especially when we drill beyond the headline 2.8% on-quarter expansion. Output acceleration was mainly inventory-driven. Stripping out inventories, GDP only expanded 0.8% on-quarter. Business investment was weak and government spending in contraction. We have been warning about investment coming in weak as the 100% depreciation policy expired in the quarter. But our main concern of a fiscally tighter 2012 is already starting to bite in government spending. And going forward, we also expect consumption to be under pressure as incomes will probably not rise fast enough to offset further benefit cuts. We therefore continue to believe that the US will post about 1.5% growth in 2012, way below the current consensus of 2 to 2.5%. As we also expect the Eurozone to be in recession this year and China's slowdown to be a drag on Asian exports, we expect Singapore growth to come in within MTI's 1 to 3% expectation with downside risks. In the short term, the STI has successfully poked its head above the 200-day moving average, closing just above 2916. While this is a bullish signal, unfortunately the S&P 500 is looking toppish with short-term risk to the downside as momentum is waning. Whether a positive STI will be affected by a negative S&P remains to be seen, but fundamentals for the short term, we think, are looking a bit risky. For one, the marked improvement in US data might start to come in below expectations as we are entering 2012 with much less economic momentum than the market had thought. And number two, Greece might still default. And thirdly, the earnings outlook for S&P 500 this reporting season is looking mixed. STI earnings outlook this season has only just begun. So far, Capital Corp beat expectations. Capital Mall Trust and SPH missed. On the other hand, market positives are: number one, the rate of contractions in the Eurozone and Asia have eased somewhat. Number two, unlimited 3-year refinancing operations by the ECB has successfully resulted in backdoor QE of Eurozone sovereign debt. And number three, Fed anchors low rate expectations till late 2014 and considers quantitative easing 3. Over the larger trend for the STI and S&P 500, we have been bearish as the economic story remains on thin ice. Chiefly, threats to a continued bull run are: number one, US 2012 growth likely to surprise on the downside, approximately 1.5%, as incomes may not rise fast enough to offset a fiscally tighter year. Number two, despite backdoor QE of Eurozone sovereign debt, yields are likely to experience upward pressure on poor debt growth dynamics exacerbated by a recession induced by collective austerity. And number three, China will avoid a hard landing, but its slowdown will be a drag on ASEAN exports. Thank you and tune in next week to Phillip Securities Research Weekly Market Watch.